Hello, Accelerators. Today on 0 to 100, I have the privilege of introducing Jerrad Havins. He is the CEO of Credilife, a financial wellness company. He is a certified FICO professional. He's been in the business for well over a decade, and he has serviced over 15,000 clients. We're going to talk about some key topics that are going to help you build your business and become more profitable, such as FICO scores, what they mean, and more importantly, how to improve them, how to become more bankable. In addition, figuring out that magic ratio between revenue and expenses when you're building business credit, you're looking to get loans, you're looking to get credit lines, how to do it, what the bank wants to see, and the way in which it can help your business. For those of you who do not know me, my name is Jerrad Guy Randolph. I am the founder of BoxFi. We are a business growth solution through payment processing, and I am very excited to share the network I've built over 25 years as an entrepreneur and show you ways to grow your business and become more profitable. Ladies and gentlemen, let's accelerate together. Jerrad, it is wonderful to have you on 0 to 100.
Thank you. I'm excited.
We're going to have a great conversation today, and we're going to talk about everything personal credit, move into business credit, how to navigate between the two, and use it as a tool to grow the profits in your business. And one of the first things I want to start with might be controversial, is that the majority of us have a very negative relationship with credit. Can you talk a little bit about that psychology and why many of us have a negative relationship with credit?
Yeah, I think it varies on the person. I've been a CEO of Credilife over 10 years. And before that, I've always had a role since I was 18 in the world of finance. I've been in this industry since I was 18 and I'm turning 40. So it gives you an idea of how long. For me, what I have noticed is that there's a few different segments of people. There are people that have gone through an issue in their past. There's a lot of different things that can happen in people: divorce, job loss. Let's say they're a business owner and they've gone through ups and downs. A lot of times what ends up happening, it's these events in their life that cause the negative impact to credit. And a lot of times people don't understand how it truly works. They've heard things, maybe pay your bills on times, like the simple, generalities, but a lot of times they don't understand the specifics of how it actually works. And I feel like when it comes to most adults, when we get confused by something, especially when it's so important and hindering us, we get frustrated, right? We get angry, like, dude, what is going on here? Why can't I get these things done? So I feel like there's a lot of times those type of circumstances can cause a negative mindset towards credit. I think there's a lot of confusion around credit when it comes to, why does credit impact insurance premiums? Why do they care so much about my score? Here, I'm out of Minnesota. We serve people nationwide. But here in Minnesota, where I grew up, it's very conservative, right? A lot of people operate cash heavy. Well, it's not uncommon for me to work with clients even here locally that have either no credit score or low credit score because they have very limited data because they're cash heavy. So there's so many different variables involved. So it really comes down to credit and money, right? That's what it is. And a lot of times people have a negative mindset towards money as well, whether it be how they're raised or hindrance of opportunities, or they're stressed out financially. There's so many different variables. So I feel like when it comes to the aspects of our life and what we've gone through, which a lot of people have gone through a lot, that to me is where I feel like that negative mindset occurs.
Mm-hmm. So one of the things I want to talk about while we're on this path is, how do we shift that? How do we start to have a healthy relationship with credit? And I just want to, before we get into that, I want to point something out. You said, why is insurance impacted by my credit score? It's the same thing in the payment processing industry. Your credit score can impact the rates that you could potentially get from your payment processing company. So having healthy credit as an individual, if you have to personally guarantee, or as a business, is tantamount to success and growing your business. Yep. So how do we and the audience start to have a much healthier relationship with credit, even those who don't have such a negative relationship, but they just don't have a relationship with it?
Yeah. I think it starts with understanding, and for me, the best way to make that happen is when you have a goal, right? When you're motivated to accomplish something, you're going to naturally, as human beings, be more motivated to either learn or take action, or both, right? So I feel like to improve that overall relationship, you got to have those things, right? Okay, you know what? I've gone through this issue. I'm over it. I'm sick of it. I want it to be better. I want more opportunity in my life. All the different emotions we may feel. I think that's the shift that needs to happen. And once someone has that shift in their mindset towards it, they're now going to be more open to learning, right? I think once again, that's what it is. And once we start to have more clarity on how this works, I reference this all the time, or I compare it a lot to fitness. Well, for me, I've gone through my own personal health and fitness journey where I've gained weight, lost weight, gained weight, lost weight. But like when I look at it, the reality is a lot of times when you first get started, oh my goodness, it's so hard. I'm in the gym, I'm having a hard time. Oh my goodness, I'm so sore. I don't want to do this again. Right? It's all those things. But then all of a sudden, when you start to work at it a little bit more, you start to lose some weight. You start to feel better. And I feel like those emotions naturally motivate you, like, you know what, this is actually working for me. Let's keep going. It's the same thing in the world of credit and money. When we start to make these adjustments and we start to have more clarity and we can start to see the light at the end of the tunnel, so to speak,
Mm.
that's when that motivation kicks in and they're like, okay, what else, Jerrad? What else can I do? I mean, all the time I hear that with my clients when they're getting excited like that. What else should I be doing now, Jerrad? And I love that because to me, that's an indication that they're getting in the game. They're starting to understand it and they're ready to pursue it further.
So, if we're talking to someone who is a business owner and they want to build up their personal credit as well as business credit, which we're going to get to,
Yeah.
but if you want to build up their personal credit, what are some good goals to set to start to get to that point?
Yeah, I think in that respect, it would be specific to where they're at. So, whether they're wanting to start a business or maybe they already currently operate or own a business, I think that's the first two things that we have to look at. Then from there, let's use the example of someone that already owns and operates a business. For me, what they need to begin to look at is one, awareness of where their personal credit's at. So, the easiest way to do that is leveraging what's called online credit monitoring. I'm not a big fan of Credit Karma just because it's a simplified summary with only two credit bureaus, not all three. And the scoring system in there, which we can go into later, is not FICO, right? So that leads to additional confusion. But there are other platforms out there. Identity IQ is a great one. It provides FICO 8 scores and all three major credit bureaus and the data within it. So from there, if we can start to get a better understanding of where we're at with our credit, that's number one. And then from there, I would say, well, most people, quite honestly, I've been doing this a long time. There is more, I would say, awareness around business credit has increased over the past few years,
Mhm.
but it's still very limited. A lot of times business owners have heard about it, but they don't really know what it means. How do I get it? How does it help me? So
Mhm.
gaining some knowledge of that. And I would say that the biggest purpose around business credit to me is twofold. One, it's creating separation of your personal credit from your business. That's a big one. And I know we want to talk more about that later, of like what that
Mhm.
actually means. And
Right.
then from there, identifying how do I build up business credit in a way that allows me to get access to more credit and capital that can be used specifically for business growth or management purposes. So that's kind of like where you want to start. Now, if you're a new business owner and you haven't started one yet, I mean, I'm telling you, if you start to get this education now in advance,
Mm.
you will have a leg up. You will, because most business owners, like I talk to clients all the time, even my father, he works in the grocery industry. He helps a lot of brands that are looking to get in, like, Costco and Walmart, these big companies.
Mm.
And that's a very, very competitive space, regardless of what product that you're pushing. But what's common is a lot of times people invest a lot of money, a lot of cash to essentially start, whether it be a franchise opportunity, whether it be a new product, they invest, they're cash heavy, right? What ends up
Right.
happening is they're looking at what they need to just get started, usually. But what happens is as they jump in, they start to realize, oh my goodness, I need more money for this. I need more money for that. Oh my goodness, I'm having a hard time execute. I had no idea that I was going to need money for this. This happens all the time. So
Mm.
as a new business owner, if you can start to have more clarity of like, how does this work? What type of funding do I need to my startup cost, my operations cost, my marketing? What type of marketing do I want to do? Start to kind of reverse engineer it. Then in advance, we can look at the personal credit, make sure we optimize your credit. And then from there, look at business credit opportunities to fill those gaps. And that's going to put you in a much better position than a lot of people and what they've gone through. I'm
Mm.
sure anyone listening to this that has a business has gone through this, and they're going to go, "Oh, I wish I would have known that when I started." You know what I mean? So I think there's
Well,
advantages on both sides.
and one of the reasons why we have you on today, because it's never too late.
Yep,
Let's
never too
talk
late.
about maximizing or optimizing your personal credit. What are some of the key factors that the audience needs to consider where they can do just that?
Yeah, so there's a few factors. I'll kind of break it down simply, and then I'll go into more detail. So
Mhm.
when it comes to the FICO algorithm, that is the credit score. That is a mathematical algorithm based on the data within your credit report, and when it's ran at that moment in time, it spits out a score, and that is your perceived risk value. The higher the score, the lower your risk, basically. So when it comes to like the general FICO wheel, which is this important to understand, 35% payment history. The one thing I like to talk about that is, yes, you obviously want to make payments on time. But more importantly, I would say most people don't know this. The reason why a late payment negatively impacts your score so much is because such a large portion of that wheel is specific to payment history. And if you think about it, FICO is a risk assessment algorithm. So you're not necessarily significantly rewarded for doing what's right or what you're supposed to do, but you are severely negatively impacted if you did something wrong. So
Hmm.
late payment is a big one. And if you think about it, if it's been recent, if you were to go apply for something and there's a recent 30-day late, well, now the perception to that lender is, oh my goodness, you were just recently late. I'm worried about extending you more money because it appears to me that you're already having an issue with repayment with someone else. So that's a big one. You want to make sure you make your payments on time. The other piece, and this one I like to focus on more because I feel like we have more control in this area. Obviously, making payments on time, we have control, but we can be more strategic in this next area, which is called revolving debt ratio. Okay, 30%, still a massive chunk of the score. And what that really is credit cards and lines of credit. In most cases, for most, it's going to be credit cards.
Right.
If that works, it's based off what was reported. What was the balance on the credit report? Is your limit? What is that ratio, right? So anytime that balance and that ratio increases, the perceived risk to a lender is higher, so therefore your score will begin to drop. And a lot of times people don't understand how this information is even reported. I'm sure you know yourself or you've heard this. A lot of times people say, "Oh yeah, I use it for the points. I use it for this and I paid off in full every month."
Hmm.
That is extremely common to hear that. Well,
Hmm.
guess what? Your payment is not what was reported.
Hmm.
When they generate the statement,
Hmm.
that information is what's reported to the credit bureaus. So if you think about it, typically your statement's generated 2 to 3 weeks before your due date.
Hmm.
So even if you paid off in full, if you maxed it out, it's going to reflect that on your credit report and cause a severe negative impact to your scores.
So you need to know your payment dates and be paying your credit cards 2 weeks prior to those actual dates that they report to the agencies.
There's a couple ways you can do it, and I think it's specific to what the goal is of the client. So
Right.
I'll kind of go through this real quick. Let's say I'm someone and I'm just looking to have a strong credit profile. Maybe I want to buy a home in the future. I want to access lower interest rate terms, right? I
Hmm.
would say my recommendation when I'm working with clients around that is it would be easier, in my opinion, where we work on a debt reduction plan first if we do have balances. Let's bring the balances down to zero. And
Hmm.
then from there, based on what we're looking to apply for a mortgage, the actual best ratio, reporting ratio is 3% of the limit. That's it. 3%.
I want to emphasize something, and because I want to make sure what you're saying is clear for anyone who is listening right now.
Yes.
The magic number to hold on your credit cards is 3%.
Yep.
So if you have a credit card that is $1,000, that's $30. If you have
Yep.
a credit card that is $10,000, that's $300. That's what you want reported to the agencies on a monthly basis. So they
Exactly.
need to have credit, but they really apparently they really don't want you to use it. But just realize it is not 30%, it is not 20%, which a lot of people think that it
Yep.
is. It's really that 1 to maximum 3% monthly
Yep.
revolving on those cards.
That's exactly what it is. It's three. What you said it perfectly, 3%. And so I would say in that first scenario, let's bring it down, and then from there we change our buying habits, where we
Mm,
only charge in the course of a month up to 3% of what that limit is. So let's use $1,000 limit credit card as an example. Well, we're only going to charge up to $30. So maybe that's a Netflix subscription and maybe a Hulu or something. Things like that are typically easier where you're already making that payment monthly and it falls within that ratio you want, that dollar figure.
mhm,
That to me is going to be the easiest way where most people will succeed because we can literally set things up on automatic payment, set it and forget it for the most part, and it becomes a credit building tool. That's what I like. However, if let's say you're a business owner, this is where we get different strategies. A
mhm,
lot of times, whether you're a business owner or maybe you're someone that does traveling sales and you get to use a personal card and you get that reimbursement and then you get to keep your miles. That's common, right?
mhm.
So for someone like that, where it's like, hey, I use this for these purposes, then to your point, Jerrad, what we would do is pull up their statement on the credit card. It's going to have a line that says statement closing date or billing cycle end date. That's the two terms that they'll use. And every month, it'll typically be roughly 2 to 3 weeks before your due date. It'll say it on there. So what you can do is save that date. You could do a reminder on your calendar, whatever it is. I would say typically 3 days. So 3 days before that statement closing date, you would want to make a payment, pay the balance down to that 3%. And then 3 days later, they generate your statement. And now, boom, we have taken control of the reporting aspect of our credit while also maximizing opportunities around points and miles.
So let's talk about some of the negative aspects that impact your credit, like a missed payment or multiple inquiries if you're going to buy a car or you're trying to get Amazon credit card
Yep.
or if you have multiple addresses on it. Can you get those things off of your credit? I think is one of the big questions.
Yeah, you can. You can. So there's a little bit of a difference between what we just brought up. So when it comes to like different address history, like think about it like this. When you look at a credit report, usually in the very beginning, it's going to have what's called personal identifying information. So it's going to be your name, different spelling variations of your name that have been used, whether by accident or, whatever it might have been. They call it AKA. They're going to have address history, employment history, phone number history. And so anything within the personal identifying information section, yes, you can totally dispute that and get that removed. That's typically relatively straightforward. You want to do your due diligence and follow up to make sure the bureau's acted properly and got it done for you.
Right.
Now, let's talk about inquiries, late payments, collections, charged off accounts. I mean, there's so many different things, right? A derogatory or negative account. So, yes, anything, it's important to understand this. Anything that is reported to the credit bureaus, they're for profit companies, okay? They
Mm,
make money on data. And nowadays, people know more about data and the value of data. They didn't before. As soon as Amazon came in the game and people started realizing, holy smokes, there's so much money in data. Data is king. The credit bureaus are the king of data. They are
hmm,
three separate companies. They are for profit businesses. When you hear credit bureau, you might think like regulatory government. No, they're for profit. It's Nike, Reebok, Adidas. That's what it is in the world of data. So information is reported to them about you. They're going to take that in. It's going to get attached to your record. And what they do is they sell that information for a fee. You apply for a mortgage, that costs money. You apply for a credit card, that costs money. This all costs money. They sell it nonstop for marketing, applications, all of it. So because of that, there are laws in place, Fair Credit Reporting Act. So because of that process, what's happened is they've empowered the consumer and really they put the responsibility on the consumer, where it is your legal right where you can challenge everything on your credit report. So typically what we would do there, and for people to understand, because a lot of times people think that was me, that did happen, things like that. It's not about that. What we're going to do is we're going to put the onus back on the creditor and the bureaus, where now they need to prove what
hmm,
happened before is accurate as of today. And you want to
hmm.
be very specific in how you go about that. You want to challenge aspects of that account history, not the account. We're not saying it's not yours. We're not saying it's fraud unless it was. We're going to challenge very specific components and aspects of that account in a way that's difficult to verify. And if they're unable to do so, The credit bureaus must permanently delete it off your reports because it's no longer verifiable data. They can
Mm,
no longer sell it. So
mm,
that is credit repair in a nutshell. That's what we're doing with our clients that need that service. It
mm,
helps us to repair the past. That's
mm,
a big piece. If we're looking to move on, we went through an issue in the past. I got some stuff on there. Guess what? We can fix it. Let's figure it out. Doesn't mean everything goes away. It can happen. But anything that's negative, that's repaired or removed, is a massive win for you because it allows us to get to the next level faster.
Do all of the credit bureaus have to report the exact same account information?
No, no, because they're separate and it's also specific to what the creditor themselves reported. So it's
Hmm,
actually not uncommon to see inaccuracies or differences in account between the three bureaus.
hmm,
In fact, a part of what we do at Credilife is we are partnered with an attorney firm. And what happens is when we're going through the investigation process, if we identify these type of inaccuracies and the bureaus fail to do their due diligence in what's being requested for investigations,
mhm.
that actually can open them up to a lawsuit. And so there are times that we'll leverage that for our clients. And I would say one of the biggest things that we identify are differences in reporting between the three bureaus for it's the same trade line or account.
Hmm. So this is really important for the audience to realize is that if you do have negative marks on your credit, there are ways in which you have the legal right to get that off of your credit report. So do not let anything that happened in the past hold you back from moving forward with success, with building personal credit and also building business credit. And Jerrad, what I'd love for you to talk about is how you marry that process of creating or establishing that personal credit and transitioning it into business credit where it's no longer based on your social security number, it's based on the EIN for your business.
Yep. Yeah. So what we do there is first step, as we talked about, we need to evaluate and do an audit of a personal credit report.
Hmm.
From there, we're going to identify areas that we can improve, we can optimize, whether it be strategic debt management, like we've talked about a few points earlier, whether that be maybe creating a debt reduction plan that works within your financial situation over time, whether it be credit repair as a tool to leverage. And there's so many different things. So we're going to do that first. We're going to see where we at and can we squeeze any more points of improvement, basically, right? And then from there, once we hit certain benchmarks, and
Hmm.
for me personally, I like my clients to at least be at a 680 FICO 8 score.
Hmm.
FICO 8 is the algorithm most commonly used for business credit cards and credit cards, as well as a line of credit for business. So
Hmm.
they're going to run FICO 8 score specifically. So we can pull that for our clients. There's no cost to it, and we'll know what that score is without an inquiry. So we can kind of monitor that and see where we're at. Higher the better. Every 20-point increment in your score typically improves the terms available to you. So if we think about it like 680 to 700 to
Hmm.
720 to 740 to 760, most lending kind of stops around that 760. That's usually the benchmark that you'll see really no difference when it starts to exceed that in most cases. But that's going to be our goal is how do we optimize? How do we improve? And then from there, what we're going to do is kind of go through a discovery process. And we really do this at the same time, but we want to know what's your business? How do you make money? What's your sales cycle look like? What type of credit and capital are you looking for? What are the use of funds, right? How are we
Hmm.
going to use those funds to benefit your business and get a better understanding of their foundation, their financial foundation? That's important for me. Um, it really is. I'll explain later as to why, but that's important. And then from there, we can identify, business credit cards, business lines of credit, maybe it's a business term loan, whatever it might be. We can begin to start to position the entity, the company, in its overall bankability to then be approved for those accounts. And at that point, this is perfect because we then create that separation. So we're leveraging personal credit to open up the door to better accounts, top tier accounts. And
Hmm.
now we're going to maximize that on the business side and build up business credit history where then we can begin to access even more. And I think that's super important for people to know because a lot of times they don't understand the two and they could easily put themselves in a position to pay significantly more on a business loan than they would have if we would have done that process first.
So let's just talk about some of the key factors and really the first step that you as a business owner need to take to start to build your business credit.
So the first step, so I would say this. So let's kind of go into the details of business credit and how it works. So you have different scores for business credit as well. So in the world of personal, you got FICO, right? That's the big player of scores. In the world of business credit, you have Paydex. Experian has a business credit score. Equifax has a business credit score. And there's also FICO Small Business Administration. The most important score of those in ranking of priority is what I explained. It's going to go Paydex to Experian to Equifax and Small Business FICO. Now, what you need to understand is that initially, I would say, dependent on the business, between 6 to 12 months of building. Doesn't mean it's going to take that long to get credit. What I mean is building the credit. The building up a Paydex score, you have to have at least 3 accounts reporting to Dun & Bradstreet and build a Paydex score, and they have to report for at least 3 months consecutively. So there's a lag time before you even see a score. And then from there, once we begin to generate a score, how we leverage that is if we're looking at certain loans that a company needs, what ends up happening is when we have a Paydex score that's positive, we have a great personal credit score. Now we've lessened the overall perceived risk of that application. So that lender is going to automatically feel comfortable to extend more credit and typically improve terms. So that's how we do that. And then over time, as we build that up, I would say in most cases, we'd want at least 6 overall accounts reporting between credit cards, trade lines, and loans. We have to build up more history. It's actually quite difficult. No, I shouldn't say that. That's the wrong term. It's not quite difficult. It can take a little bit longer. But once we build up enough, that's when we can open up opportunities where you have further separation where they no longer need to even pull personal credit in an application. So there's a process there where we marry the two and then they get divorced in good terms.
Right.
You know what I mean?
Well, that's a great analogy. Where does Dun & Bradstreet come into play?
Yeah, so Dun & Bradstreet, what's so funny about this is, they're the biggest player in the world of business credit data. They operate the same way as the personal credit bureaus do. They take in data, they sell it. And so I'm sure any business owner out there have been bombarded by Paydex. They have a very strong sales division where they're constantly pitching their products, all their different products, building business credit, all the different stuff. The issue is, what most people don't know is you don't have to pay for any of that. You can get a DUNS number for free. When you open up accounts that actually report to Dun & Bradstreet, it's gonna happen on its own, just like it does with personal credit. When it reports to the bureaus, it's a similar process. So Dun & Bradstreet, the best way to leverage Dun & Bradstreet really is for the data and tracking of the data, like you would a credit report, to make sure everything is accurate and make sure that your information for your entity is accurate. To give you an example, Jerrad, this actually happens quite often. Let's say we have a business owner and they've moved locations. Maybe when they first started their business, they used their home address. And then all of a sudden, a year or two later, they're doing good. They open up a brick and mortar office.
Right.
Well, it's not uncommon. What can happen is that when information is reported to the business bureaus, my terminology is they're not as sophisticated as the personal side is, where it kind of takes in that data and gets associated to your account. What ends up happening on that specifically is they would actually open up a separate record under the same company because of the difference in the address. And so what ends up happening is if you have accounts that were reported to one previously with your personal address, and let's say we have a new account that's reporting to the business, in theory, we'd have 2 separate profiles with 2 separate scores now. We need to bring them together. So once again, the reason why that's important is Dun & Bradstreet, we use that for data, accuracy of data, and monitoring and awareness. And that to me is their greatest benefit and the best tool and how to leverage them.
That is key information. So for the business owners out there, just as a recap, getting that DUNS number, that Dun & Bradstreet number is really important. Making sure that your information is accurate. And as soon as you possibly can, establish that official business address that you're going to be using. Because if you change from a personal address to a business address, you're going to lose the credit that you've built under that personal address for your business.
Yep.
So it's key to actually have that physical or that business address from day one.
Yep.
Now, Jerrad, you spoke about something earlier that was really important in passing in terms of bankability. What does that mean, and how important is that for you when you're going out and getting lines of credit or actual loans for your business?
Yeah. So for me, bankability means understanding how to position your company or your entity to get access to the credit and capital that you deserve and that you need for growth.
Mm,
And an example of that would be this. Let's say a lot of what we're discussing, a business owner does not do. They've been in business, let's say 2 years, they generate consistent revenue. Maybe they have fair credit. It's not horrible, but it's not great, and they go and apply for a loan. Well, I'm sure you've seen this, Jerrad. I get it all the time. I'm a business owner. There are a lot of finance brokers in this world, and they do a lot of marketing. And so a lot of times what they'll do in their marketing is they're going to position the top tier best case scenario in up to X amount, as low as this percent.
right.
Well, a lot of times what ends up happening is when you're not truly business bankable, you're going to be shocked at what comes back for an offer for a loan. It is not uncommon for interest rates to be in the 20, 23%. There are different ways where they do terms like with business loans or even a line of credit. It's not uncommon to get daily payments, weekly payments, bi-weekly payments in their terms instead of monthly. There's a
Mm,
lot of variation in the world of business finance. And the reason why that's happening with these business owners, and I'm sure anyone watching this, I wouldn't be surprised if someone has a loan like that or has had a loan like that. It's very common. And they don't know any better, right? They're just thinking, "Oh, this is what I can get. I need it. I'm going to do it." But
right.
business bankability means understanding how to position the overall entity, making sure everything is updated correctly with our state, with Dun and Bradstreet, all the different administrative type stuff. That's important. We need to make sure that we're operating in a way that shows less perceived risk. Well, that's one, building up business credit history as well as cash flow management. I
Mm,
spend time with my clients all the time on cash flow management because essentially what you want to do are two things around this area. One, ideally, we want to show a certain amount of revenue coming in, and then we want there to be a specific gap between revenue and expenses. There's a ratio in there. Lenders are going to look at that. The better that ratio is, the lower the perceived risk. This is where we can leverage business credit cards with delayed spending to increase the gap between revenue and expenses. So if we're doing cash heavy on everything or a large purchase or whatever it might be that we could have put on a 0% business credit card and
mhm,
had a lower delayed spend over time to make sure we account to pay it off at that end of that term, 12 to 18 months usually.
mm,
These are the things that we can do to begin to position the overall entity to be truly business bankable and really just hitting all the crossing off, the T's and the I's of what lenders really look at in the world of business. So that way, when you come to the table, really you're going to command more respect in the way, and they're going to be seeking your business versus you coming out with your hand out. You become like their ideal business client for lending. And that's the goal that I have with every one of my clients.
So to be business bankable, what is that magic ratio between revenue and expenses?
It's dependent on the type of loan. And
Okay.
so really what that ratio would be is if we had an idea, which we can do this through loan calculators, we want to make sure that we have a ratio that one allows for that payment to be made and an additional ratio, and anything beyond that basically continues to lower the perceived risk. So it is dependent on the loan amount, the type, and the amount of what that payment is. So a
Mm,
part of what I'll do with my clients is in that discovery phase is getting an idea of what type of credit and finance do they need, and then
mm,
we'll have an idea. This is more specific to like a business loan right now. I'll have
mhm,
an idea of like, hey, if we get a $50,000 loan at an 18-month term or 3-year term, whatever it is, we can kind of map that out. And I'll have a pretty good idea in advance of what that payment will look like. And if we have to make adjustments to their cash flow to meet those expectations in advance, then
mm.
we're going to do that. So really what we're doing in that respect as part of this program is we're pre-underwriting before it even hits underwriting. That's what we're doing.
Gotcha.
Which you understand the world of underwriting in your business, you get it.
Right.
That's what
Yeah.
we're doing.
So if you're a business owner and you're trying to decide between what type of credit product that is going to be right for your business. How much of an impact does your type of business have on making that decision?
That's a phenomenal question. And I imagine a lot of people don't even think about this. So I'm glad you asked it, Jerrad. Your type of business does matter when it comes to lending. And so every industry, so basically there's something called NAICS coding. And what that does is basically puts your company, your entity into a specific coding or bracket of type of business and a segment within that industry. Well, lenders, obviously, it's all about perceived risk, right? So
Mm,
they're going to monitor what's going on with the economy. How are their loan portfolios performing? To give you an example, for a long time there, trucking was a really strong industry and lending was very popular with trucking, and they would extend a lot of great loan offers for people in the trucking business.
mm,
That's changed essentially, I would say, around the COVID time, post COVID. There's a lot of changes happened due to inflation and all different things that's impacted trucking specifically. So the
mhm.
default rates for trucking has gone up. So therefore, your specific coding of your business now has a larger perceived risk if you apply for something. So either dependent on the bank, they may simply decide we're no longer going to lend to this type of industry right now, or what they might do is significantly reduce what they'll extend to you to
Oh, wow.
essentially build up a relationship to prove that you're going to be, bankable and make your payments on time. So there's a lot of different things. So what I'll do with clients is, if this is more specific for someone that's looking to start a business or maybe has an opportunity to make some tweaks to their business,
Okay.
we'll evaluate if there are ways to legally, is a big one, right? We don't want to be deceptive, but you'd be surprised. There's a lot of different coding out there, and it's you could, like, for instance, consulting. There's so many segments within consulting, and a lot of times people, let's say real estate. Right now, if you are flagged as a realtor or broker, that's actually considered higher risk right now. But
Hmm,
let's say with your real estate business, you do consulting work and you consult other realtors on how to improve their business to close more transactions. Well,
hmm.
technically, you have a right to state that you are a real estate consulting business. So what you would do is change something more in a consulting segment within that code. But that's just an example. So this is where we can get more strategic, where we do things right, but we're just opening up the doors to have a better understanding of what's available to us to leverage that to our advantage. That makes sense.
No, that actually makes a lot of sense. So there's a lot of complexity around, for better or worse, around your credit profiling, deciding what loans make sense for you based on where you are in your business. Most of our audience are existing long term business owners, and some of them have experience in the world of business credit. Some of them don't have experience in the world of
Yep.
business credit. But those who, I mean, for me, it's only been the last 3 or 4 years now that I really understood what business credit was. And I've been in
Yeah.
business for 25 years.
Yep.
Well, I was always leaning on my personal credit, but now shifting over to business credit, it's much different because it's now the onus is on the company and the strength of the company and our revenue. One of the things I'd like to understand, because credit doesn't always solve the issue. How do you decide between going after credit or going after capital or investment capital for your business when you're trying to take that next step forward in your growth path?
Yeah, it's a great question. If I'm understanding correctly, there have been times when I'm working with clients. Let's say they do have some credit challenges,
Hmm.
but we're in a position. Let's say they've been in business. We have great revenue. We have a nice ratio between revenue and expenses. It's really just credit holding us back. Well,
Right.
yes, there are lending opportunities that will base it off your revenue and look at other compensating factors, that will impact the term and the interest rate associated to that loan. But this is what I do and my team does, our team of 14 here at Credilife. We're not the typical, hey, transactional company. We're not like
Hmm.
a loan officer. We're not a finance broker only, where it's like, hey, I'm just looking to close this loan and move on to the next one. That's not how we operate. We want to understand that if we're working with you, and we can broker out all the deals on your behalf all day long. We do that. We can broker all the financing. We can help you with all the legwork. We do all of that. But it's important to have an understanding that if we're going to take advantage of this loan, is there going to be a realistic ROI, and when will that be? And in the meantime, between that estimated timeline, does the company have the ability to sustain that payment? This is one area that I feel is overlooked greatly by a lot of people, because they may be in a position where, like, look, I'm growing like crazy. I know I need to fix this, but dude, I need money now, right? This is because I know this happens all the time. Well, the thing is, if you think about it, they're operating off of emotion there, and they just know they need something, but they maybe haven't taken a little extra step to better design. Okay, well, if I can get this, how am I going to use it? Use of funds. And do I
Mhm.
feel comfortable that, hey, you know what? We can weather this. We can handle this for 3 6 months. These payments, we're going to be golden. We can do this. So that's a big part of what we do, is we bring clarity to that side of it, of use of funds. And then once again, if we know that they can do that, we can always go back and address the credit. We can always go back and do these things. So that way in the future, when we refinance, we're going to get better terms and open up that whole door for them. But hopefully that answers what you're looking for. Is there are ways. We just want to make sure, at least for me, I never want to put someone in a bad position. I don't want to be someone that advised them to do something, and also they come back and go, Jerrad, this loan is crushing me right now. Because
Mm.
I've had conversations when they reach out to me that have been referred to me, and it wasn't me that put them in that loan, but that's what they tell me. This loan is crushing me in my business right now. So I've learned from that over the years, where it's like, you know what? This industry deserves more of a holistic consultative approach.
Right.
And that's what I'm delivering, is that right there.
Right. You did answer the question, because what I would like our audience to understand is that there are options, especially if you have a business which has really great revenue and you
Yep.
can sustain those payments, versus it just being on your credit at that point in time. But no matter what, you need to make sure you have a healthy credit profile, personally and from a business standpoint. So
Yep.
before we go into the rapid fire section,
All
Jerrad,
right, let's do it.
give us 3 credit hacks that we can do today as business owners to start building our business credit.
Okay, so the first one we got to do for personal, because it's going to impact the business. We
Okay.
talked about it before. This is very important. Pull your credit report, go to identityiq.com. It's like, $20 to pull it. It's not a hard inquiry. You're going to get your FICO 8 scores. Pull that, pull up the report. The first thing you're going to do is look at your credit cards, identify what the reporting balance was and what the limit is. Within your financial means, pay that down to the magic number of 3%. That's number one, 3% of the limit. So if it's 1,000, pay it down to 30. Number one, because as soon as that updates, you're going to see a significant boost in your scores. Even if you're already at a 680 plus and you have higher ratios, I'm telling you right now, you'll probably be 720 plus. So
Awesome.
that boost is huge. Then what they can do, the next step, is identify local regional banks in their area. And there's a lot of benefits of working with a regional bank in your area. Because if you think about it, for large institutions, you're just a number in most cases. Unless you're slinging big, big, big money, you're typically just a number. Like Wells Fargo, you're probably just a number to them. Whereas if you go to a regional bank, they operate differently. They have a lesser pool to work with. They pride themselves on relationships. Like, it's going to be a different experience for you. And with that, they typically have a lot of really strong small business tailored options. So what I would say there is identify a regional bank and open up, ideally, a 0% business credit card. And the reason why I say 0%, it's very common right now. They'll do a promotion where they'll do an introductory period at 0% interest. Typically 12 to 18 months is most common. And what you then want to do is use that,
Hmm.
identify accounts that you can begin to use that card with those expenses. So you improve that cash flow, what we talked about, right, at 0% delayed spend. That now we're starting to build up some history. And then the final piece that I would say, dependent on the type of business that you're in, is look at what's called trade lines. And this would only be if there's a benefit to your business. Maybe you're in construction. Maybe you have an office. Anything where you can identify a company that offers business trade lines. They're essentially extending your business credit, like a line of credit, to purchase from them. Home Depot has it. Sherwin-Williams has it. Quill has it. Amazon has it. There are a lot of companies out there that have that. And so what you can do is identify something that actually has a positive impact to your business while also building up history. And that's a win-win. So those are three things that you could do right away to start improving your overall position.
Awesome. You just gave us some incredible information. Now we're going to go into the rapid fire section. You ready?
I'm ready, dude. I'm ready.
Quick answers.
Okay.
Rabbit or turtle?
Ooh, rabbit.
Coffee or tea?
Coffee.
If it is a zombie apocalypse, you've got to get out of the house, protect your family. What is the weapon that you are grabbing?
Ooh, I think a sword.
I see you as like a Viking. Anyway, that was a great.
I got the Ragnar beard out.
Yeah,
Double axe is what I'm grabbing.
Not a kitchen knife, a sword, guys. A sword.
Gotta go big. Gotta protect my family.
One of the number one business books that you recommend.
Oh my goodness, there are so many. There are so many. You know, I really enjoy, hopefully I'm not butchering the name, but I recently read it about a few months ago around curating an ultimate offer. That that book was amazing to me. It's that gentleman that's very big on YouTube. I really enjoy his work. That has been extremely beneficial for me because it's important in the world of sales that your messaging and how you position yourself appeals to the audience you're looking for. Obviously, with the best intention, appeals to the audience you're looking for. Obviously, to how that works.
If you could choose anyone, dead or alive, to have dinner with this evening, who would it be?
Oh, oh my goodness. That's a great question. You know, I'm sure people are looking for some significant figure, but quite honestly, it would be my grandfather, Clyde, my dad's father. And the reason being is I didn't get an opportunity to get to know him very well when I was young. He was a prisoner of war. He has a lot of history. He was a big figure in our family and my dad. And I just wish I had an opportunity to get to know him, especially what he went through. I just feel like that session with him would just be amazing. So that's who I'd choose, my grandpa Clyde.
That's so cool. What is something in your industry that you truly feel needs to be changed?
Oh, that's a great one. In the world of personal credit, there needs to be companies that no longer only provide credit repair services, meaning the
Mm,
letters. I think that is the biggest issue because a lot of people feel like that itself is the solution, when in
mm.
fact it's not. It's a part of the solution. So to me, it's misleading. I think that needs to be changed. Why we don't do that? We do everything. In the world of business, what I would like to see changed is more transparency in marketing of specific loans, business loans. I think
Mm.
that they need to be more transparent around providing a credit score bracket and a range that they could expect. So that way people have a better understanding of where they're at and if they should pull the trigger on something. I think that needs to change.
Okay. If I walk through your front door and you're a business owner who's doing $10 million in revenue on an annual basis, and I give you a $300,000 check, how would you advise that business owner to invest that 300,000 to double their profits over the next 12 months?
Oh, I love that question. So for me, the very first step there would be better identifying exactly how they make their money,
Mm,
identifying areas where they're leaving money on the table. I like
mm,
to start there first because that's typically common that we don't necessarily have to invest a lot of money into fixing that. Could be done through software solutions, training of the team, whatever that might be. So let's figure out where money is being left on the table. And then from there, understanding how we're going, what the growth needs to be, and investing in opportunities to create more prospects or conversions or more sales dependent on the type of business. I think that to me is the first thing that I would be looking at.
awesome. And last question, and the most important question: what is the biggest obstacle that you had to overcome in your life or your business to become and build the success that you have today?
Wow. I've gone through a lot, and it's not nowhere. It's never a pity party. Never, never in my life will ever be a pity party. Definitely, have gone through a lot. I've experienced my own ups and downs in this business. You know, post COVID was actually when we experienced our significant negative impact to our business, just because we're so closely aligned to what's happening in the world of mortgage, real estate, and finance. And when interest rates shot up like they did and inflation went up, we felt that negative impact severely as an organization. And that really forced me to make decisions. I had to make tough decisions that I didn't want to make around layoffs. I had to really evaluate my personal lifestyle situation, which I advise people to do all the time. I did it myself. I had to make sacrifices to make sure that I was in a position to take care of my family and cut back where necessary to then make sure I'm reinvesting into my business to be resilient, weather that storm. And then from there, we had to be creative on how we can get in front of the right audience, even though, it was a little bit more difficult. We just knew we have to make these adjustments and we have to create more awareness around what separates us and what people are looking for. So that to me was the biggest hurdle that I've experienced, because Credilife, I started 10 years ago. It's my first business I've ever started and we're still going, right? So this was, I'm not too proud to admit, I'm constantly learning, so I lean on others to learn. I lean on experience. And those experiences really help shape you, whether for the better or for worse. And I think it's about your mindset and how you approach it, right? So, but that to me was my biggest obstacle that was overcome.
Awesome. Jerrad Havins, please tell the audience how they can connect with you.
So you could go to credilife.com. That's our main company website, Credi with no T, life, so credilife.com. You can reach out to myself and my organization there. My personal site is jerrad360.com. That's JERRAD 360.com. You can reach out to me there directly. And I know we're going to be giving away something really nice here that will include, I know Jerrad's going to put that out there. We have a really, really cool solution that you can take advantage of at no cost. And what it does, allows you as a business owner to put in some specific data points that we'd want to better understand where you're at. And we actually generate what's called like a report card for you, where we'll help you identify, here's areas that I'm strong, here's areas that need work. In addition to that, we're able to break down different segments of different types of financing. And if you meet pre-approval guidelines right now, or if you don't. So it's a really nice starting point to give people some clarity. So I know we're going to be including that for everyone to take advantage of.
Awesome. We will make sure that the link to the business finance scan is in the information and the write-up on this podcast. Jerrad Havins, thank you for joining us on
Thank you.
0-100.
Thank you so much.